In this presentation, we'll cover uses of accounting information in the financial statements. We're going to concentrate on the first learning objective in the text, which involves defining accounting, identifying business goals and activities, and describing the roles of accounting in making informed decisions. Accounting is an information system that measures, processes, and communicates financial information about an identifiable economic activity. It supplies the information decision makers needed to make reasoned choices among alternative uses of scarce resources in the conduct of business and economic activities. Accounting is also a link between business activities and decision makers, and decision makers use the accounting information primarily aimed at making decisions in the future. It's sort of in a planning mode among available alternatives. Accounting measures business activities by recording data about them so that we can use them in the future, and it is communicated to decision makers through reports. Here we have a slide that shows how this works. Business activities take place. Accounting is involved with the measurement and processing and communication of data, and we turn that into information for decision makers' use. Now, a business can be thought of as an economic unit that aims to sell goods and services to customers at prices that will provide an adequate return to its owners. We have two primary business goals: profitability, which is the ability to earn enough capital or enough income to attract and hold investment capital, and liquidity, which is concerned with having enough cash available to pay debts when they are due. We can think of business activities in terms of three areas: financing activities, investing activities, and operating activities. Financing activities are activities associated with obtaining adequate funds or capital to begin and continue operations. Investing activities are associated with spending funds to begin and continue operations. Buying resources such as land, buildings, and equipment needed in the operation would be an example of an investing activity. Selling those resources when they're no longer needed would also be considered an investing activity. Finally, activities associated with the course of running the business are considered operating activities. These are commonly in a manufacturing business. This involves selling goods and services, employing people, buying goods and services, that'd be the purchasing or procurement function, and paying taxes. Now, we also are concerned in accounting with performance measures, which are indicators that can be used to determine whether managers are achieving their goals and whether the business activities are well managed. Performance measures could include earned income, information about cash flow, financial ratios such as expenses to revenues, and other ratios such as money owed to total resources controlled. Financial and management accounting usually is divided into two categories: management accounting and financial accounting. And there's some overlap between the two. But the primary difference lies in who is the target audience of the information. Management accounting focuses on internal decision makers, that be managers and employees. The reporting format is more flexible, and it's based on the type of information that the internal users need. Management accounting is also involved with reporting past performance and expected future performance. So the concern is on the past as well as the as well as the future. With financial accounting, the focus is on external decision makers. That primarily involves stockholders, banks and other creditors, and government regulators. Financial information of the company is reported in the financial statements, and it's used to report directly on those business goals of profitability and liquidity. Now, sometimes we get involved with the difference between bookkeeping and accounting. Bookkeeping tends to be those tasks that are repetitive, more mechanical in nature, and they're involved with the finance transactions. Now, accounting can encompass the bookkeeping, but that's just a small part. It also is involved with the design of an information system to meet users' needs and the goals, the analysis, the interpretation, and use of the information. Accounting information can be processed by bookkeepers, by computers, and by management information systems. Now, management information systems, or MIS for short, can be thought of as the information that's needed to run a business. It consists of interconnected subsystems, and most important, the subsystems is the accounting information system. That certainly is an accounting bias here. Okay, we're near the end. One discussion question: what's the difference between profitability and liquidity? Profitability is concerned with earning enough income, that's revenues minus expenses, to attract and hold investors. And liquidity is concerned with being able to have fund available to pay debts